Identifying levels of support and resistance to create trading zones. Now, we all know that trading at or around support and resistance is a key ingredient to a successful trading strategy. You're going to hear us talk about this time and time again. Okay, it's very important for our setups that we trade them at or around key levels, key supply and demand levels. Okay, so isolating these zones prior to price reaching them will make your trading setups even more powerful. Plus, it gives you a lot more confidence when you've pre-isolated a zone where you're looking for price to react and you start to see that reaction. It's important to think of support and resistance as a zone and not always an exact number or level, since price often trades through these levels before we see the real reaction. We talked about this a little bit earlier as well when we're looking at trend lines or Fibonacci levels. Price doesn't always stop right at the exact level. Sometimes we see price trade through that level before seeing the real reaction. Now, our most popular measured support and resistance trading zone is the 50 to 62% Fibonacci retracement zone. And that's because the way we trade, we like to trade pullbacks. Okay, we like to wait out the initial move and then trade the pullback, okay, instead of trading breakouts and things like that. Okay, that's just how we trade. I personally think it's a more efficient way to trade. It also gives you a better reward to risk normally than the breakout strategies. Also, the 100% to 127.2%, or how you'll often hear me refer to that as equal legs in 127 zone, is a very common target area, which also makes it a good level of support and resistance to end a price cycle. Now, some different things we'll look for: key swing points, the big figures, shelves and ceilings, trend lines, pivot points, fib retracements, fib extensions, fib projections or expansions are all forms of support and resistance, but work even better when used in a confluence. So we'll look for confluences of these different support and resistance levels. We'll try to isolate these levels and wait for the market to come to us and then watch for our trading setups. And that's how we're going to do it. So let's go and take a look at how we isolate these key trading zones and some of the things that we look for. Now, we'll show more examples. This is one example. I know we've shown this here already, but this was after a divergence, after we had a cycle to the downside. We had price moving higher, magnitude swinging lower. We set up, what we did is we draw our Fibonacci retracement on the swing, and we look for price to pull back into the 50 to 62% zone. Okay, so this essentially becomes our trading zone, which means we're waiting for price to pull back into this zone before we enter into a trade. Now, this is using the same degree. We can also set up trading zones on higher degree time frames and then drill down to the smaller degree time frames to look for patterns. But in this example, let me go back to our daily trade plan chart for the 7th, which was May 7th. And I'm just going to bring that over here and show what we had here. So this is what we had on the 7th. Okay, and you can see here, this is a qualified divergence setup as well. So this is something we'll get into here in a little while. This is a very specific trading setup that we do trade. But it works the same way. We see the price move, we set up the trading zone. If price moves into that zone, we enter into the trade. Okay, so we set up this trading zone of this 50 to 62% for price to pull back. If price pulled back there, we'd enter into the trade for the down cycle. Okay, and in this scenario, you can see price pulled back right to the edge of the trading zone here. And this was actually a pretty interesting time. I absolutely do not trade on the back of news releases, meaning that I don't enter into the market because of a data release. Okay, if there's too many factors can come into play. So I don't enter long the US dollar because good data came out of the US. Just don't do it. Okay, it depends on market sentiment, plus the volatility can just be, too crazy. So, but what happened here is we were waiting for this setup. This was actually NFP day. And we were waiting for this setup, and price came up and rallied prior to the NFP report, price rallied right here. Okay, pulled up and rallied. Then the NFP report came out, and the NFP report came out as expected. Basically, no deviation. Okay, it came out right in the range as expected, so it wasn't, it wasn't a negative number, it wasn't a positive number, but price had just rallied here and was sitting here. There was not a lot of volatility happening at that point in time. The number was released. Price prior to that number had already rallied up to this level, so I went ahead and pulled the trigger on it. My thinking being that we didn't get a big deviation, so we didn't expect, a lot of really crazy volatility since there was no deviation, and we didn't have an overly negative number or an overly positive number. So I went ahead and stayed with the technical pattern, and that's the trade that we talked about earlier in the course here. Obviously, this is right now today. You see the price action is moving here as we're doing the course. And then obviously what happened was price just kind of trickled down here and hung right around this level where we closed for the week. So we didn't see any kind of movement here towards a target before Friday. Then I closed out the trade there. I was thinking about reopening it when the market opened. I just wasn't in front of the charts at that time, and then we already had price move down, so I just left it alone. Okay, took my smaller profit off the table and just stayed happy with that. Okay, but anyway, I had set up a trading zone, and when price rallied into that level, that's when I was looking to place a trade. Okay, not before, but when price moved into that predetermined level. Okay, here's another example on a recent chart. The market has been downtrending. We marked this off as a potential triple, a W, X. We had this labeled as a Y wave. We weren't seeing any divergence here on this most recent swing. And looking at the scope of the market, which we'll talk about here in a moment, looking at the scope of the market, we were looking for this to continue down. Also, we had our WX, so we were looking for this to continue down towards equal legs of that pattern. And I had this marked at the time where we were at as a Y, but actually the Y wave is here. And this is current price action, but you can see here we identified, again, we wanted to see a corrective pullback. If price pulled back into this 50 to 62% zone, we wanted to look for the sell. And we had a nice little confluence here with the 50% as well. All right, so you can see previous price support in here. We looked at term resistance. Price came right up to that 50%, and down we went right to equal legs, right to that equal legs target, and that's where we found some support here at the moment. Okay, this is a current trading setup here. Here's another current example on the dollar yen. Okay, the dollar yen, this is also a qualified divergence. Price moving lower, MACD swinging higher. Price rallied up here above the points that diverged. We had this pullback. This was a level right here, the 50 to 62%, where we were watching for a potential price reaction. Okay, this was our long zone. Excuse me. This was our trading zone right here, the 50 to 62% on this divergence. And you can see price came right into the 50 to 62% zone, and that's where we've seen the rally so far. All right, now once price tests the high in here, this is when we want to go ahead and make sure we have the risk out of the trade. And even at this point, we could start to use these swings, since we do have some pretty solid swing points here, to reduce risk, remove risk, and lock in some profits in case this level does indeed hold. Anyway, that's just how we do trade management, like we talked about earlier. Again, didn't really want to get into the setup there. Just wanted to talk about setting up these trading zones where we're looking for our actual entries. Now, here's our Euro-Dollar 4-hour chart. And this is another example of a trading zone that we have set up. Price hasn't gotten there yet, and we don't know if it will. We don't know if it will. And actually what we'll do with this is we're going to mark off a caution zone here as well, right here, because we have such a high confluence, or such a strong confluence here at that 38%. So what we would do is we would mark off a caution zone here. We have a few reasons. We have the low point between the points that diverge there. We have the 38% Fibonacci retracement. We have previous price resistance. We would look to term support. This is what we call a shelf. Okay, so if price comes into that level, strong potential for a price reaction. This is setting up these trading zones. Now, obviously, we'd like to see price come 50 to 62%, but since we have such a strong confluence here, we might not see that happen. Now, if price pulls back into the zone, what we'll do is we'll drill down to the smaller degree time frame, and we'll look for a setup to develop there, potentially a divergence setup or an extension, something that gives us an idea, a clue that we can enter into the market with good risk management. Okay, and that's what it's about. That's what setting up these levels of support and resistance, creating these trading zones, is all about. And we'll do it time and time again, and this is where we'll look for these trading setups to develop. Okay, so this is a 4-hour chart. We're going to watch if price comes into that level. We're going to start to drill down, look at the hourly chart, look at the 15-minute chart, look for setups there for trading opportunities. Okay, and if you do this, if you take the time to develop these trading zones where we have strong supply and demand levels and we take setups that develop at these levels, you're going to be very successful in this business.